Hi, this is Alessio. Hope you're well. Well, guys, it's now official. The most dangerous signal for the markets is now triggered, as you can see here, just this week. And in case you're wondering, why am I talking about the stock markets? Why not Bitcoin? Because as I'm sure you know by now, what happens to the stock markets has a major impact also on Bitcoin and crypto as well. So that's why, guys, it's important to pay attention to what's happening right now on the stock markets, because we've just triggered what's called the kiss of death signal. So I'm going to talk about this, guys. What does this mean for the markets? And plus, guys, I'm going to explain to you what this chart you can see here, what is this telling us as well. All right, guys, join me. Alright guys, welcome back. So this is the video I think you've been waiting for. Many have been asking me, hey Alessio, when are you going to make a video about this? Well, here it is, guys. You see, the infamous kiss of death signal has just triggered on the stock markets, as you can see here. Now, for those of you who watched my previous videos, you probably know what the kiss of death signal is. If you happen to be watching my videos for the first time, let me just briefly explain to you what the kiss of death is and what it implies, and then we'll go into the other charts. Let me just say I've got a lot of charts to cover with you today. Got this one, plus this particular one you're seeing here. All right, guys, before we go into those other charts, let me just explain this point. So what happened was, and essentially the kiss of death triggers as per the rules when the stock market from all-time highs, so these were the all-time highs here, the S&P, then falls below and closes below the 21 monthly EMA. And very important, guys, it has to be the S&P 500, not the Dow, not the other markets, the Nasdaq. It has to be the S&P we're talking about here. So closes below the 21 monthly EMA here, then bounces back towards the monthly 21 EMA, the blue line. And at this point, you can see what happened here. Bulls tried to get something going to the upside, but at this point, sellers came in, and essentially like Tony Soprano, you know, when he does a hand gesture that he does, sellers came in and they said, hey, forget about it. And essentially they pushed it back down again, as you can see here. So essentially at this point, bulls failed to get this market back into an uptrend, and sellers or bears succeeded and pushed it below the lows that we made before the bounce. And that's what causes and triggers the kiss of death, which is what we have here. It triggered just this week. So far, you could say, in the words of the greatest president of the United States, my favorite president of America of all time, Mr. Frank Underwood.
It's all going according to my plan.
Yes, thank you, Mr. President. It is so far going according to plan. Now, before we continue, let me just say a few things about this. You may be wondering, well, what does the kiss of death actually mean? You see, guys, in the past, when this occurred, let's have a look at 2008. So this is the year 2008. Notice what happened that year. The stock market, the S&P, from all-time highs, it fell below the 21 monthly MA, closed below it, then bounced back towards the 21 monthly MA, and at this point, it failed, as you can see here, and took out the prior low. That's very important, by the way. It has to take out the prior low before the bounce, and that's where the kiss of death gets triggered. And essentially the stock markets then drop, here by 50% from its highs. Here's the famous .com crash. Again, in that period, as you can see here, after all-time highs, the stock market dropped and closed below its 21 monthly MA here, bounced back to it, and then failed, triggered the kiss of death. And again, the stock market then dropped by 50% from their all-time highs. Let me show you the next one here. In 1973 to 1974, we had a classic example of the kiss of death, as you can see here, and then a major bear market ensued. Then the next one, and this is interesting, I want to show you this because there are times when this does not happen. So you can get false signals too. As I'm sure you know by now, nothing in technical analysis is certain or 100% definite. There are always going to be whipsaws and false breaks. And we had this in the year 2015, 2016, as you can see here. So we had a kiss of death here. As you can see, it did trigger that year. But notice that was a false signal, okay, a false break. Now, the reason I'm showing you this is because we need to appreciate there's always a risk the market could do the opposite of what we expect. There are only probabilities. There are no certainties. Let me show the next one here. 1969, my favorite year. So that year, notice the stock market from all-time highs closed below its 21 monthly MA, pulled back to it, and then essentially triggered the kiss of death, and then we dropped significantly lower. Of course, the most famous crash in history is the 1929 to 1932 crash. The Wall Street crash of that year, the stock market closed below its 21 monthly MA, pulled back to it, and then dropped below the lows, triggering the kiss of death. By the way, in that period, the stock market dropped by 89% from its highs. That was a severe depressionary bear market. So guys, in a nutshell, by triggering the kiss of death in September of this year, the stock market has now increased the probability of a potentially long-term bear market. By the way, let me just mention this. If you've been watching our member videos, then you probably know by now that we had early warning signs of this potentially big drop in the stock markets. In fact, here's a very short clip. I'm going to play this for you and we'll come back. Let's say the stock market were to rally here. Let's say we get above 4,042, and then let's say we get rejected. So let's say the price then gets rejected, let's say from these levels or even from potentially from these region here, okay, and then a subsequent move down, taking out the lows, the closing lows, a subsequent then drop below the lows, whatever the lows were here, that also would trigger a bear market. That also would be quite dangerous for the stock market because it could mean it could fall lower to test the lows of June and potentially into lower levels. All right, guys, thank you for watching that video. And again, that's why it's so important that you watch the members video on a regular basis, because we go into the markets and the charts in much more detail. And as you can see here, when the market was here, I was already warning that, look, if we get a bounce, like the one we had, in fact, in early September, and then a breakdown below the pivot lows here of near 3908, 3900 here, that actually could trigger a primary bear market, which it did, by the way. And that increased the risk of further downside pressure towards the June lows. And we also mentioned the key target in our member videos, that was the 200 weekly moving average, the one you see right here. By the way, that level, that green line on my chart at 200 weekly, as I'm sure you know by now, is a very important level in technical analysis, a very important support level in technical analysis. In fact, you can see in the past, whenever the stock market has approached that level, probably with the exception of 2020, but in the past, the stock market has managed to hold that level, as you can see here. And now we're back there again at the 200 weekly. So it's a very important support level, and that's going to be a very important test now for this major decline and a potential bear market now in the major stock markets. We have to wait and see what happens here in the coming days and weeks. By the way, let me mention that I personally think the market's going to go below this level. So even though the market has come down to 200 weekly, I think this week, potentially in the next few days, we could see more downside pressure in the stock market. And I think we could see a bit more downside here. If you look at the monthly chart, look at the monthly chart right now, and notice we're getting very close now to a very important level on the monthly chart. It's the 50 simple moving average there, the white line or the grayish white line on my chart. So I think the stock market is going to have a meeting here with the 50 simple moving average here on my chart, probably in the next few days. So that's why I think we're going to see more downside, and potentially we may even breach this level as well. Now here's the important point. Let's go back to our chart here on the stock market. So we've had a kiss of death. This is now confirmed, which, as we saw a few minutes ago, has in the past resulted in major downside pressure and crashes like the one in the year 2008, and also like the one in the year 2000, and so on and so on. But here's something I want you to pay attention to. Notice that after a kiss of death gets triggered, like the one in the year 2008, look what happens afterwards. So for example, if you look over here, in the year 2008, yes, we had a kiss of death, okay, but look what happened immediately afterwards, or soon afterwards. At this point, the stock market triggered the kiss of death, okay, on this bar, but look what happened in the next couple of months. Notice that in the next couple of months after a kiss of death, we actually had a bounce, a strong bounce here. I know it doesn't look very strong here on this monthly chart, but it was quite a bounce, as you can see here. Okay, so the market rallied for at least a couple of months here in the year 2008 before then resuming the bear market. Okay, let's go back to the year 2000. Same thing happened that year. In that year, after we had the kiss of death, as you can see here, it triggered on this bar. Then notice after some more downside pressure, look what happened afterwards. Then for at least a couple of months, notice that we had a bounce, a very strong rally. In fact, the pullback occurred again towards the 21 monthly EMA, the blue line on my chart here. So notice a very strong bounce before then continuing the bear market lower. By the way, my calculations show the average period for a potential bounce after a kiss of death is about 2 months. So about a 2-month period for some kind of a bounce or a pullback or a rally in the market. Look at the year 1973. Now, in that year, when the kiss of death got triggered, in fact, it got triggered on this bar, on these 2 bars here, okay? Now, notice what happened here. The market then bounced back. It had a 2-month, maybe a 3-month rally or bounce before then continuing the bear market, okay? Look at the year, for example, 2015, 2016. Now, of course, we know that was a false break, but nonetheless, look, the pattern repeated. After the kiss of death got triggered, notice we had a bounce soon afterwards. Look at the year 1969. Again, after the kiss of death got triggered that year, look at this, okay? So after this bar triggered the kiss of death, notice we had at least 2 months, which is the average period for a bounce after a kiss of death, 2 months of a bounce or a rally in the stock market before then continuing the bear market. Now, here's something else I want to show you. And this is also very important because it has a bearing on what I just said. The dumb money versus smart money index, as you can see here, and notice the sentiment readings. So while the smart money is actually quite bullish or positive on the stock market here, as you can see, the dumb money is very bearish. They're extremely bearish right now on the stock market. Notice a divergence. There's a divergence now occurring between the smart money and the dumb money. And whenever this divergence occurs, whenever these extremes, so guys, what's important is the extremes, not the middle bit. We're not interested in the middle part. We're interested in the extremes, okay? Whenever there's a massive divergence between smart money and dumb money, confidence in the stock market. So what does that mean? Now, what it does not mean the stock market is going to rally back to all-time highs. No, it doesn't mean that. But what it does mean, in fact, what Jason says here, this data is courtesy of Jason Geppert, and what Jason says here, he says, after extreme divergences like this, stock markets usually bounce by 4 to 5% over the next 2 months. Now, guys, notice what he says here, 2-month period. Notice, and remember, guys, as I just explained a few minutes ago, the average time period for a bounce or a rally after a kiss of death is over the next 2 months. Very important here, by the way, guys. So we could potentially see some kind of a bounce or rally according to this data as well. Look at this, by the way, guys. Now, this is something I mentioned before in my previous videos. I'm sure you know it by now. It's called the Halloween effect. This Halloween effect essentially means that after mid-October or after Halloween, the stock markets have a habit of rallying or being quite strongly positive from October to December. Now, I'll explain to you when exactly in October this usually happens. But again, from October to December, usually a positive period. But as you can see here, it's no big surprise. Notice this. Again, in September, as I'm sure you know by now, September is seasonally a weak and negative, by far the worst month for the stock markets, as you can see here. And we've seen it already also in the stock markets this last September. But generally, as you can see here, statistically speaking, by no means a guarantee. We're not saying it's a certainty, but again, statistically and historically, October to December has usually seen a bounce or a rally, some kind of positive, again, momentum in the stock markets. Now, let me be very clear about this. I'm not saying that from the start of October, we could see a bounce, although it's possible. But actually, look at this. This data is also courtesy of Jason Geppert. And what Jason says here is that, look, not every part of October is the same. The first half of October, I would say the first part of October until about the 10th to 15th is not very good. All right, so as you can see here, the first 10 days of October is usually negative, lots of red negative bars. You can see here, again, these are seasonal pressures, okay? Generally, in the first half of September, rather a negative bias. But look what happens towards the middle. The closer you get to the middle part of October, the more positive it tends to be. By the way, notice that does not last very long, because from the 21st, 22nd to the 27th of October, notice that we get more negativity, more negative pressures in October. So that's not going to be a good week either, from the 22nd, 21st to about the 27th. However, check this out. From the last half, the last part of October, near Halloween, the closer you get to Halloween, look what happens. Positive pressure, positive momentum usually comes back in towards the latter part, the late part of October, towards Halloween. Notice, by the way, this blue line, which, as you can see here, this blue line says to us that the most positive, the highest win rate seasonally for October is about the 28th of October, as you can see here. Close to Halloween is what we're talking about here. So what we're saying, guys, is very simply that as we get closer to Halloween, we should be careful that quite a big bounce is going to come in and could last at least a couple of months towards December. By the way, this should come as no surprise to you because, as you know, in December, we're talking about also the Christmas rally as well. As I'm sure you know, generally around December time, towards the second part of December, we get what's called the Santa Claus rally or December Christmas rally and so on and so on. So you're probably thinking right now, okay, well, so what? So what if the period from late October Halloween to December is bullish? And so what if the dumb money, smart money index shows that we could have a potential 2-month rally? And so what after a kiss of death? Typically you see a 2-month bounce or something like that, as we saw in previous bear markets. Well, here's the reason, guys, because even though I think in the short term, even though I think in the immediate short term, like in the next few days, potentially the next couple of weeks, we could see more downside potentially in the stock markets perhaps. But I think, guys, be careful, be very careful, because I think from late October of this year, so from late October to potentially December, we should be getting ready for a big bounce, potentially a big rally in the stock markets. Again, I'm not saying the stock market's going to rally back to all-time highs by the end of this year. And that's ridiculous. Of course not. No, all I'm saying is based on the data, based on previous historical bear markets, as well as the dumb money, smart money index, as well as the Halloween effect, we should be getting ready for some kind of relief rally in this period from Halloween, from late October to December. And by the way, guys, that rally, when it potentially occurs, is going to tell us a lot of information, because that bounce or rally is going to tell us whether the stock market is going to continue the bear market and push lower into a much bigger long-term downtrend and bear market like the ones in 2008, the year 2001, and so on and so on, or is it going to end the bear market and be a false break or a false signal? So that next big bounce from Halloween, from late October to December, is going to be very important because it's going to give us a lot of information about what's going to happen next year in the year 2023. So is it going to be a major long-term bear market or something else? Now guys, make sure tomorrow you watch my members video, because I'm going to be joining forces with my good friend and analyst Charlie Burton, and both of us are going to analyze the chart of stock markets here. We're going to go into this chart with Elliott wave theory in much more detail. Plus we're going to talk about Bitcoin, we're going to talk about Ethereum, we're going to talk about the currency markets. We're going to go into the charts in a lot more detail tomorrow on Sunday in the members video. And guys, if you're not a member, make sure you join today. Go on that link, which is also in the description, and you can become a member and get 3 months extra free as a member as well. All right, guys, thank you very much indeed. I look forward to seeing the next video update. Bye for now.